what is equity release and what is a further advance, and also explaining what a remortgage is. Make sure you stay tuned until the end because I'm going to explain equity release, remortgages, as well as further advances. And I'll also then be able to explain the criteria to you. My name is Anthony Lindsay, and I make these videos not to replace speaking to a qualified professional, but that I can talk through various things that you might want to discuss with your mortgage broker. I do find that as a mortgage broker, there are various questions that I get asked all the time, as well as the fact that sometimes customers or clients use terms that aren't clearly defined. So I like to define terms that I can understand and answer my clients' questions in the very best way. My name is Anthony Lindsay. I've been in finance for over 30 years. I've done everything from debt management to wealth management to lending. So when you speak to me, you're getting 30 years worth of experience from a broker that's done various different things and will always put you as the client first. The way that our firm works is you do not pay unless we are able to get you an offer. So make sure that if you do book an appointment, you book it in advance, that we can go through everything. We can explain how our fees work. So the zero broker fee situation is not a promotion. It's how we work every day. When you go to a fee charging broker, you want to make sure that you're paying for results and not promises. So we make sure that we offer you results and you do not pay unless we get you results. But today we're going to be talking about further advances, equity release, and remortgages. Remember, your home may be repossessed if you do not keep up the repayments on your mortgage. So accessing equity in your home through your lender can be done two main ways. So when people are asking about equity release, it's usually one of these two things. It's either a further advance where you borrow additional funds from your current lender, sometimes at a different rate to your main mortgage. The other one is a remortgage. So remortgage can be just traditionally when you reach the end of your fixed term, or it can be because you want to raise additional funds or you want to release equity. It's where you switch to a new lender, repay the existing mortgage, and raise extra funds at the same time. Both routes give you the access to cash tied up in your home, but they involve different costs, processes, and suitability checks. My friend Muzzy, who has an amazing property course, make sure you check him out online. During one of our podcasts, what Muzzy said is, you can't take a brick to pay for bread, which is to say, when you have equity in your home, you can't just go to the store and say, I have equity in my home. In order to release that equity or in order to access that money that you have in your home, you're going to either do a remortgage, a further advance, or I do have a video on HELOC, so home equity line of credit. A HELOC is quite different. So a HELOC gives you access to the equity in your home and you use it as revolving credit. Make sure you check out that video. But first, let's start with a further advance. So what is a further advance? So a further advance is where you stay with your current lender. So this is one of the key things and one of the main differences between a remortgage and a further advance is with a further advance, you're staying with the lender that you're currently with, the lender that you already have your mortgage with. It's an additional loan secured on your home. So it's a second charge, it's another loan. So when you log in to your account, to your mortgage account, you'll see two separate loans. So you'll see your main mortgage, you'll see the further advance. It may have a different interest rate from your main mortgage because it is a different product. It's a different amount. And it's useful if you want extra funds without changing lender. So you might want to stay with the existing lender because by staying with the existing lender, it's a little bit easier. The process is a lot quicker. Here's the criteria for a further advance. So it's an existing mortgage in good standing. So the current mortgage that you have, so the mortgage that you're paying each month, it has to be in good standing, can't be in arrears, you can't have had issues on payment arrangements. In many cases, there's a minimum amount of time you have to have held your existing mortgage, usually at least 6 to 12 months since the original mortgage was taken out. So they're going to do affordability checks because it is an additional loan. You need to be able to demonstrate to the lender that you can afford to make these additional repayments. So you're still paying your mortgage, but you're also now paying an additional loan. So the lender reassesses your income, your outgoings, the credit, just like a new loan, because it is a new loan. The purpose of the funds. So it must be an acceptable purpose to the lender. So home improvements, debt consolidation, major purchases. So when you speak to your mortgage broker about potentially doing a further advance, you're going to want to be clear and demonstrate what you're using the funds for. It is possible to use the funds for more than one thing. So you may want to do some home improvements. And while you're doing the home improvements, you also want to consolidate some debt. And you also then want to go on vacation. So there can be multiple uses, but each of the individual uses have to be acceptable to that lender. So you have to make it clear. And it's also percentages. So, like, let's just say you're borrowing £100,000 and 70,000 of it is for home improvements, 20,000 is for debt consolidation, and 10 is for, let's just say, to go on vacation. There can be percentages, but the way that they're going to assess it is what is the bulk of the money going to. If the bulk of money is going to debt consolidation, then it's for the most part viewed as debt consolidation. But this is something that you will discuss in detail with your mortgage broker. Some more of the criteria for a further advance. So loan to valuation limit. So the loan to valuation is the amount of equity you have in your home versus how much you're borrowing. So let's just say your house is worth 500,000 and you owe 300,000. So it's worth 500,000, you owe 300,000, you have 200,000 pounds worth of equity. You wouldn't be able to borrow that full 200,000 pounds as a further advance. You would have to make sure that the loan to valuation aligns with the lender's acceptable criteria. There are minimum and maximum amounts. Some lenders set a floor, so a lower limit, which would be a maybe £5,000, and some will set a maximum amount. So that's above and beyond the loan to valuation. So when you're speaking to your mortgage broker, you'll be able to get a feel for how much you can borrow to stay within the loan to valuation and make sure that it's within the floor and ceiling limits of that particular lender. And the interest rate, it may be different from your main mortgage product. It's a separate sub account. So as I said, when you log into your mortgage account, you will see that there is the main mortgage. It will have its interest rate, it will have its term, and you will see this sub account or the further advance, but it will all be in the same account. It may have different interest rates. It may even have different terms. So you may just need, a smaller amount and you take out £10,000, but you don't want that £10,000 to run for 20 years alongside your mortgage. So you may do that £10,000 for a shorter term. But each lender is going to have their own individual criteria. So make sure that you're discussing your needs, your situation, the outcomes that you're looking to get with your broker. Now, there's a very, very, very different thing. So we just talked about further advances. So a further advance is where you're getting additional money from the equity in your home with your existing lender. A remortgage is different because a remortgage means you're going to a different lender. So obviously, because you're going to a different lender, it can be a little bit more admin for you. There's going to be more hoops to jump through because you're going to a different lender. The reason why someone might choose to go to a different lender, do the remortgage as opposed to the further advance, is they may not meet the criteria for the further advance with their current lender, or they may not be able to get as good an interest rate with their current lenders. There's different reasons why someone would opt to release equity via a remortgage with a further advance as opposed to just doing a further advance with the existing lender. So you switch to a new lender, you pay off the old mortgage. This is a key thing. So you're paying off the original mortgage that you had and you're borrowing more money. So let's use that scenario again. You have a property worth 500,000. You owe 300,000, which means you have 200,000 pounds worth of equity. You then pay off that 300,000 pounds that you owe to your original lender. And then let's just say you need an additional 50,000 pounds. So you are now doing a remortgage where that 300,000 pounds is paid off and the 50,000 pounds is given to you as the cash in hand for whatever you want to use it for. The thing to remember now, though, is now instead of paying payments on 300,000 as you were before, you're now making monthly payments on 350,000 pounds. So quite often when I do remortgages for people, either because their fixed term has ended or they're looking to raise capital for various reasons, and I show them their new monthly repayments based on the same term. Let's just say they had 20 years left on their original mortgage and they're remortgaging for 20 years. And I say, well, your payments were 1,700 a month. Now your payments are going to be 2,000 a month. They're like, well, why is it more? Because you've just borrowed more money. So you owe more money. Therefore, you're repaying more money. So you can access better rates if your circumstances have improved. I love when this happens. So I love when a client, maybe when they first got their mortgage, may have had some credit issues, let's just say, and they had to go to a specialist lender. They stayed with that specialist lender 2 years, 3 years, 5 years, whatever. They tidied up their credit. They put themselves back in a solid position. And now, because they've done such a good job with their mortgage, they're now able to not only remortgage and raise additional funds, but they're now able to go with one of the main street lenders. So now they're able to access better interest rates. The remortgage can often be more flexible, but it involves fees because it is a new mortgage, you're going to have to pay for valuation potentially, legal fees, product fees, all of the things that you might have paid for when you took out your original mortgage. So that's a remortgage. Let's just look at some of the criteria. So the remortgage criteria. Most lenders want you to have at least 10 to 20% maximum loan to valuation, usually 80 to 90%, lower for buy to lets. So what that means is, again, your property is worth 500,000. You owe 300,000. You're doing a remortgage. So you pay off the 300,000 you owe, you're taking out 50,000. You wouldn't be able to take out the full 200,000 because the property is only worth 500,000 and you have to pay back the 300,000. So you wouldn't be able to take it to what's called 100% loan to valuation, which means you owe as much as the property costs. So you wouldn't be able to do that. Usually they want to see that you're between 80 and 90% loan to valuation. If it is a buy to let property, so you're remortgaging a buy to let property, and I do have a lot of videos on buy to let mortgages versus residential mortgages. But if you're doing a remortgage on a buy to let property, then the loan to valuation is usually going to be around 75 to 80%, but it's not going to be at that number of a residential property. Payments must be up to date with no recent arrears. There are some exceptions to that in that there are specialist lenders. However, for the most part, you're going to want to make sure that you have missed no mortgage payments. You had no late payments, no missed payments within the last 12 months. Some lenders will look at it if you've made maybe one missed payment or late payment within the last 7 months. But if you can make sure that you're completely up to date, you haven't missed any payments, or you haven't had any late payments or anything like that, it's going to give you the best opportunity to get the best rate with the best lender. But as I always say, I'm not giving financial advice, legal advice, or tax advice. And I'm not talking you through this that you can take my advice and go and do something. I'm talking you through this that you can understand enough to go and speak to a mortgage broker, that you can ask questions, or maybe you've already talked to a mortgage broker and you didn't feel comfortable asking certain questions. So certain terms were being bantied about, further advance, loan to valuation, remortgage, whatever, and you didn't feel comfortable asking questions. So these videos are there to help explain things in a way that you can pause, rewind, watch again, but make sure that you have the financial literacy that you need to be an informed consumer. And you need a cleanish mortgage history. That's going to be one of the vital things. A satisfactory credit record, though some specialist lenders can accept adverse credit with restrictions. So, what that means is your credit profile, not your credit score. I say it all the time. You want to make sure that your credit profile is positive. You want to make sure you haven't had any late payments, missed payments, CCJs, defaults, anything like that. Although the caveat is, if you have had any of those things, you can look at a specialist lender. So, more of the remortgage criteria: lenders check your income, outgoings, and debts. So, again, it's a loan, it's a remortgage. You are going and getting a new loan with a new lender. They need to know what your income is. Are you self employed? Are you full time employed? Are you part time employed? Do you have benefits? Are you paying personal loans, etc.? One of the positives with the remortgage or even with the further advance is, let's just say you're doing a debt consolidation further advance, or in this case, a remortgage. And let's just say you're servicing personal loans and credit cards, and those amount to £1,000 a month that you're paying out. Let's just say you have £20,000 worth of credit card loans and personal loans, and you're paying £1,000 a month. The great thing about how they assess your income and your affordability is, because you're now transferring that debt into the further advance, which will usually be at a lower rate, they're not going to take that £1,000 out of your affordability, because in essence you're not paying that £1,000 anymore. So if you're doing debt consolidation and the purpose of the remortgage or further advance is partially debt consolidation, it can free up more money for you per month. So you're taking unsecured debt such as credit cards or personal loans, those are unsecured debts, and you're adding them to your mortgage. So you're converting a loan that you already owe of £20,000 that might be on, let's just say, 23% because it's a credit card, and you're now putting that into your mortgage payment. So it can actually reduce the amount of money that you are paying each month without borrowing more money, because you already owed the £20,000 on credit cards and personal loans. The affordability is assessed using current lender stress tests and interest rate assumptions. So stress tests are looking at how much does it cost to live right now? What is inflation looking like? What is, electricity and gas and all of those things looking like? So it's not just like you make £2,000 a month and you say, well, I'm paying £700 a month in credit card, personal loan, electricity. They're also going to look at the cost of living at the moment. So that's the stress testing. Most purposes are allowed for debt. So you can do debt consolidation, you can do home improvements, raising funds for purchases. But as with a further advance, you want to make sure that you have a clear, honest, open conversation with the mortgage broker, that when they put together your mortgage application, or in this case, the remortgage application, they're able to detail and document to the lender what the use of the funds is. In a lot of cases, especially if you're doing large refurbishments or home improvements, the lender may ask for a breakdown of what you're doing. They may even ask for a quote. And that's not to trip you up. It's not to be nosy. It's because they understand how much things cost. So if you have a one-bedroom apartment and you're saying that, you're doing a new kitchen and it's going to be £30,000, that doesn't sound right. So always be honest. Always be honest. The worst thing you can do is be dishonest, because not only will that impact the ability for you to get mortgages in the future, but it may put you in a really bad legal situation. Some lenders restrict business use or speculative investment. So what this means is, some lenders won't allow you to say, well, I'm borrowing this money to start a business, or I'm borrowing this money because there's this stock that I want to buy. You will need to declare the purpose of the funds and why you're borrowing the money. Always be open, always be honest, And as it says here, some lenders, so there are other lenders that are more flexible. So there's no need to be dishonest because there are specialist lenders that can meet most needs and can assist you for most legitimate legal purposes for raising additional funds. So we've covered off a little bit about further advances and a little bit about remortgages. They're both ways of releasing equity in your home. I make these videos to increase and improve your financial literacy. This is also why I wrote my book. A mortgage is a really big loan. The book covers off some basics about finance, not just mortgages. It's a great gift if you know anyone who has recently relocated to the UK and they just want to understand how finance works in the UK. It's also perfect if you have young adults who are on their journey to purchasing a property and just starting their life. It gives them fantastic guidance. It comes from 30 years of my experience working in finance, both in the US and in the UK. So, if you have young people who you want to make sure that they have the basics and understand what they need to do to be able to get on the property ladder and not be a part of generation rent, this is a great gift. It's available on Amazon. It's called A Mortgage is a Really Big Loan. It's written in a way that anyone can read it, understand it, take the concepts away, and be able to be successful and have much better financial literacy. So we've talked through remortgages, we've talked through further advances. If you're interested in either of those things, what do you need to do? I'm going to talk you through the step by step. How do you prepare for a further advance or for a remortgage? First and foremost, make sure you check your credit report. You should be checking your credit report at least once a year. My advice would be twice a year. But before you proceed with a remortgage or a further advance, make sure you check your credit report. And I don't mean just your Equifax or just your Experian or just your TransUnion or the number you get through your banking app. You should get your credit report from checkmyfile.com. The reason why you want to use checkmyfile.com is because it's going to give you a comprehensive consolidated credit report. So it's going to show you Equifax, Experian, and TransUnion. It's going to show what searches have been done on you. It's going to show any late payments, missed payments, CCJs, or defaults. It will also show repossessions. It's important that you understand your credit situation before you look to do a further advance because this will determine which lenders you'll be able to work with. The other thing that you want to do is review your budget. Remember, you're borrowing more money. So that means you're going to be paying out more. Can you afford it? Is it the right thing for you to do? If you're on high interest credit cards, it may be a good thing to consolidate that debt because you already owe that money. And the interest rate on your credit cards might be higher than what you could get if you did a further advance or a remortgage. I'm not here to tell you that there's one size fits all. I'm just saying that you should consider these things. Make sure you check your budget. And also, if you're an older individual like me, make sure that it aligns with when you plan on retiring. Because if you're doing a further advance or a remortgage, you want to make sure that these things are cleared before you retire because you might be on a fixed income. Get a mortgage statement. So get a mortgage statement. How do you know how much you owe on your mortgage without looking at the mortgage statement? So most lenders are going to give you an online portal that you can look at your mortgage. You can look at the repayments. You can look at the interest rate. You can also consider, are you in a fixed term? So if you're doing a remortgage, which as I explained, you're paying off the existing lender. If you're in a fixed rate term, then there will be early repayment charges. So if you're on a 5-year fixed and you're 1 year into your 5-year fixed, the early repayment charges could be quite high. So you're going to want to make sure that you factor in any early repayment charges, or in that case, a further advance may be the best option for you because that way you can avoid those early repayment charges. Make sure you speak to your mortgage broker. This advice is not legal advice, it's not financial advice, and it's not tax advice. And there can be implications to benefits and other things by remortgaging or doing a further advance. So make sure you speak to a qualified professional. Speak to the mortgage broker early. Don't wait until the last minute, which I see all the time. If you're thinking about it and you're vacillating and you're unsure, that's okay. Speak to the mortgage broker early. What I do find 9 out of 10 times, people have this idea in their mind, well, should I do it? Should I not do it? And they're just going around and around and around in their mind. Then when they decide to do it because the credit card bills are too high, or they're about to miss a payment because there's issues with their cash flow or whatever, then they go to the broker last minute and they transfer all of that pressure, all of that stress, all of that urgency onto the mortgage broker. Now, we're professionals, we're licensed professionals, and we're used to it, but it can be avoided. In my world, I always advise people and encourage people to speak to a mortgage broker 6 months before you think you're ready to do a thing. Most professional mortgage brokers are happy to have the conversation with you. They're not going to charge you for the conversation, and they will be able to advise you and prepare you that 6 months down the line or 4 months down the line, when you're ready, all your ducks are in a row. This is one of the reasons why I do a free mortgage capacity report. So, free mortgage capacity report. This is where you call me, you explain your situation, you explain the desires and the hopes of your heart, and I will put together a plan on how you get there. It's not a credit check, it's not even a mortgage application, but it will give you transparency and all the information you need, that when you are ready to do a mortgage application, you have the answers, you have a feel for the numbers. Now, as a caveat, if you come to me 6 months before you're ready and we look at some numbers, we look at some rates in real time, 6 months later, the rates may be different, but at least you'll have a feel for what you need to do, what the numbers look like, what the repayments look like. Or you may decide that in looking at it, there's other ways of doing it. There's better ways, there's less expensive ways, or there's ways that don't involve as much admin. But the key is to be prepared and not to wait until the last minute. That would be my best advice to you. And as you're preparing and as you're reviewing your situation, make sure you don't forget about estate planning. This is one of those things that is a passion of mine, explaining to people that you're going to die someday. And if you own a home and you're paying a mortgage on it, especially if you're married, do you want to leave that burden to the surviving spouse? Do you want to have a situation where, because you pass away, your kids are now in jeopardy of losing the home that they're growing up in? Estate planning is not one of those things where the mortgage broker's talking to you about it because they just want to sell you stuff. We are required by law to make sure that we offer you a solution to any gaps you have in your life. So the three things that we'll talk to you about are income protection. So income protection means that there's a policy in place that if you are off work due to sickness or to accident, you have an income coming in. It's a very specific conversation, and our protection department is there to support you. They're not there to sell you stuff. So that's income protection. Critical illness, some people call it cancer cover. Critical illness cover is a policy that you can put in place that if you are diagnosed with a critical illness, there's a policy payout for you depending on the terms and conditions of the specific policy that you take out. But critical illness cover is a safety net for those people like myself who maybe have lost family due to cancer. I lost my father, I lost my grandmother, I lost my grandfather, and various other people who I really care about, I've lost to cancer. So when I was doing my mortgage, I made sure and put something in place because I know that it's an important thing. And not too long ago, on one of the podcasts, I interviewed a woman from UW, from Utility Warehouse, and we were just talking about saving money, etc. The purpose of the conversation was not protection. But during the conversation, she brought up the fact that she had taken out a mortgage. During the mortgage process, she actually did have the conversation with the broker and had a critical illness cover. I think she said within 2 years of taking out the mortgage, she was diagnosed with cancer. She survived because I was interviewing her, and it paid off her mortgage. How amazing is that? So she was diagnosed with cancer, which nobody wants to hear. However, the stress and burden of worrying about how to get better and how to pay a mortgage was halved, because now all she had to do was focus on getting better because her mortgage was paid off. And the other thing that we speak about, which is a no brainer, and that's why I usually do it last, is life cover. So, life cover is pretty straightforward. You're going to die. Life cover is a policy that you can put in place that when, not if you die, if you're still in your mortgage term, when you die, it can pay off your mortgage. This is an overview of the products. I'm not giving financial advice, legal advice, or tax advice. Make sure you have a serious conversation with your broker about these products. So, life cover, income protection, and critical illness. And as part of it, when you are doing your mortgage, it's a great time to review your will. I think they said about 60% of people in the UK don't have a will, which is crazy. You should always make sure that you have a will in place. Even if it's just a basic will, there's some great companies out there that can do a will for you. But when you're doing your mortgage, it's a great time to review it, because maybe you've had kids since you took out the original mortgage. Maybe you are doing a further advance, which means the amount that you owe is higher. So that's why you would want to review your protection, but also review your will. When you do a will, if you read my book, you know that I say I have a whole chapter dedicated to wills. Make sure that everybody knows what everybody knows. So if you're doing a will, just kind of let people know I've done a will, that they kind of have a feel for when the date is. Whoever the executors are, make sure people know who the executors are, and disclose to your friends and family, anyone that's involved or impacted by the will. Let everybody know what everybody knows. And what I mean by that is, I have an older daughter and a younger daughter. I got married quite late in life. My younger daughter is with my wife, and then my older daughter was with my girlfriend at the time, etc. But my older daughter knows what everybody's getting. My younger daughter knows what everyone's getting. My wife knows what everyone's getting. My brothers, my sisters, my mom, everybody knows what everyone's getting. That way, it means after I pass, there's no dispute. There's no, well, daddy told me this, and no, but husband told me this. No, but everybody knows what everybody knows. If there's any issues around that, I can deal with that now. I think quite often the reason why people don't have this discussion or don't put a will in place is because they're like, I'll be dead. Who cares? This is what a lot of West Indian people will say. They'll say, I'll be dead. Let everybody just deal with that. I think it's a very selfish way of doing it. But anyway, make sure that everybody knows what everybody knows. And because you are doing a mortgage or a remortgage, make sure that the deeds and everything is put together properly, and the right people are on the deeds, and your family knows, because you should be preparing an estate for future generations. So in the Bible, it says, a wise man leaves an inheritance for his children's children. That's a huge task. So having the right protection in place, making sure that you're deliberate in your property pursuits, can contribute to you leaving an inheritance for your children's children. Today, we've covered off remortgages, further advances. Sometimes when people are talking about equity release, they may be talking about lifetime mortgages, which account for about 95% of later life lending. Sometimes they might be talking about reversion mortgages, but very rarely, because that's only about 5% of the mortgage. I do have a video where I cover off lifetime mortgages, reversion mortgages. A lifetime mortgage, in a nutshell, is a mortgage where an older person, usually over the age of 55, takes some equity out of their property, but they don't have to repay it until either they pass or they go into full-time care. So that's a lifetime mortgage in a nutshell, but I do have another video on that where I go into that. The key thing with lifetime mortgages, and particularly with reversion mortgages, make sure you get independent legal advice, because these things do impact your estate. My name is Anthony Lindsay. And as I said, if you need a mortgage broker that will deliver and you pay for outcomes and not promises, make sure that you reach out to me. Within the first 10 minutes of our initial conversation, I'll be able to establish what I can do for you. I'll explain my fees. But as I said, there are zero broker fees if we do not get you an offer. I make these videos that I can explain maybe some things that might be complex or some jargon that you might have heard. I don't make these videos to replace speaking to a qualified professional that you know, that you trust, that can answer your questions. I don't give legal advice, financial advice, or tax advice, but I am a licensed mortgage broker and I'd love to talk to you. So if you have friends or family that need a mortgage and want to speak to a mortgage broker, make sure you book an appointment. I appreciate you watching and make sure you like, make sure you share, and make sure you subscribe. Even if you've watched just about a minute of this, make sure you subscribe because it lets the YouTube algorithm know that what I'm doing is valuable and people want more. And please do leave a comment in the comment section. I do my best to respond to all of the comments. And if you're a broker, if you're an individual, or if you're a parent and there's a topic you'd like for me to discuss, please put that in the comments.